Then good morning, everybody, and welcome to this joint Silver Peak and Field Fisher webinar. I am Pietro Strada, Managing Partner at Silver Peak. Today's format will be presentations followed by a Q&A. We will start with a brief introduction by me on the trends in the M&A and funding market. Then Tim Bird, Head of Technology at international law firm Field Fisher, will discuss legal issues relevant to deal making in the current environment. The next spot will be the highlight of the event, when Matthew Hare, a successful serial entrepreneur and currently CEO of Zoom, which recently completed a £100 million financing round, will share his personal experience and lessons of getting these transactions done. Then my colleague Paddy McGuire is going to speak about practical points for optimal transactions and deal making, and which hopefully will complement Matthew's speech. Then we're going to pass to a Q&A session, which Paddy will chair. I encourage you to submit questions using the online feature, and any questions not answered by the panel, if we will run out of time, will be addressed subsequently afterwards. For timing, we should be in a position to start the Q&A by 9:30 and conclude promptly at 10 o'clock. So I will start now with a brief overview of the market. Let me just briefly introduce the firm. Silver Peak advises outstanding technology companies on M&A and larger financing transactions. So we work with technology companies only, we're sector specialists, when they conceive a deal. And we help them to prepare, work through it, and conclude it successfully. We serve a very international client base of European, can you go back 1 second, Alex, please? Of European clients, and give them access to global counterparties. Thank you. We cover the technology sector, and we divide it into 7 subsectors, which you can see here on the slide. So we have a relatively broad concept of technology, as today technology is quite pervasive across different markets. We have we have a track record that goes back many years. I've been doing investment banking in tech for 20 years. And as a firm, we have done some amazing transactions recently, including, in fact, advising Matthew on its fundraising, on Zoom fundraising, that you can see the second tombstone from the top left. But equally, we have sold companies to Facebook, to Cisco, and to many of the biggest buyers in the world. So coming to the meat of the presentation, this is a slide that presents financing for tech companies in Europe. If you focus on the right side of the slide, you can see that 2020 was a year a little bit of two halves. The first half, which is the bottom dark bar, was significantly below the first half of the previous year of 2019. But the second half has recovered in terms of value. So we estimate that circa almost $10 billion will be invested across different stages in tech companies, which is up from $7 billion the year before. And in fact, even if the number of transactions has gone down. So again, there is a market that is active with significant capital available and larger deals effectively. Next. Focusing only on the B and C rounds, which are really rounds for growth companies. So companies that have a proven business, but are looking for capital to accelerate or expand internationally or across products. You can see that this market also has experienced a very strong second half, which is the last right bar. And dividing the analysis between B and C rounds being obviously the later stage one, you can see that it has been a positive environment. The number of deals, which is the top line, however, has stayed more or less flat. So there hasn't been a decrease, even during H1, even if the capital invested was less. Again, there is a tendency in the second half of the year to do larger deals. Next. When we look at the investors in these rounds, we find a quite busy space, effectively. 82 investors, in fact, participated to B and C rounds in the last 12 months. When you analyze how many investors have been repeat investors, the population, in fact, thins out. And you can see to the right the names that have done more than 7 deals, such as Axel, BPI, or Idinvest. In fact, 2 French names and 1 global fund, and more than 6 deals, EQT Ventures, Insight, Partech, Salesforce Ventures, etc. More than 5 deals and 4 deals. So there is a group of repeat investors that are very active in the market, doing more than 4, 5, 6, 7 deals, and then a large group of investors that have done a smaller number. But it's a fragmented market that requires some knowledge to understand the exact preferences and modus operandi of each fund. We then looked at which segments or what themes had been driving investments. And we looked, if you do the analysis, the most active market is really SaaS, which is the software as a service, of course, which is mostly market for enterprise clients, where there have been more than 50 transactions, both at B and C rounds, followed by fintech, which is again a very active market, where the dynamics of information, again, are paramount. In finance, information is everything. And there is a huge wave of innovation in that market due to information sharing and the opening up of siloed information repositories within banks, for example. Mobile is a very active theme. Artificial intelligence, again, something that is quite horizontal and pervasive, and we've seen cutting across different markets, from automotive to finance to enterprise efficiency. So some themes are clearly catching the attention and the opportunities. Passing now on to the M&A market, excuse me. Deal count has resumed. There has been a pause. So if you look at these bars, they are the quarterly value that has been transacted as part of the acquisitions. And at the top of the line is the number of deals. If you look at Q1 and Q2, on the left is, in fact, North American targets. North American companies have been acquired. On the right is European companies. Q1 and Q2 have seen a sharp decrease. That was when the market came a little bit to a halt. Everybody was worried about the market conditions and the broader conditions of the economy, and several transactions were put on hold. We experienced some of that with our clients. However, as the companies sorted themselves out, reforecast the numbers for 2020, and in many cases took measures to preserve cash, the activity started to resume. And what we have seen is in Q3 and Q4, an acceleration of transactions leading to a very active market. So if you look at the Q4 bar, again, the dotted part is just the annualization, because the analysis is done as of the 1st of December. And we expect that there are going to be several more deals closing or being announced, in fact, in December. That bar is very high. In fact, is the highest estimate that we have for the last 4 years. If you move to the right, in Europe, the situation is similar, again, with a potentially record quarter in Q4 2020. However, the value of transactions in Europe is significantly smaller than in the US, because Europe is a smaller market. Again, the US has been always leading in terms of transaction value and number. In effect, the number of transactions is not that different between the US and Europe. If you look at 373 versus 342, but Europe is a more conservative market with a smaller typical deal average in size. In fact, this slide analyzes exactly this. We looked at the transactions by announced value, and in Europe, only 29% of the deals are above 100 million, while in the US it's 63%. So the size of deals in the US market is significantly larger. This gap has been consistent throughout the years and is slowly closing, but it's far from closed. If you look at some of the largest transactions that have happened in 2020, several are American. Again, we don't have the recent acquisition by Salesforce of Slack because it just happened after we completed the analysis. But you can see, for example, Standard & Poor's acquires IHS Markit, which effectively is a combination of IHS, a US company, and Markit, which is a UK company. The acquisition of NVIDIA, of ARM by NVIDIA, again in the UK, a very strategic deal of the leading microprocessor vendor in the world. And AMD Xilinx, another semiconductor transaction. Here we go, sorry, Salesforce Slack is there. So we have been able to include it. And analog devices, Maxim. So there are some semiconductors, some enterprise software, and information services. And on the right-hand side, the largest PE-driven transactions with Apollo, Advent, Insight, Clayton, Dubilier & Rice, and Elliott being the private equity houses that finance those deals. So again, this is just a selection of large transactions. Interestingly, on the right-hand side, again, on the PE-led deals, there is a Swiss company, VM, as well as a UK company, Cobham, as targets. Again, an active market with some very large transactions happening. I think this is the last slide, looking at the geographical distribution. The size of the circles represents the number of deals in the country. And you can see that the UK has been the largest and most active market by number of transactions in the second half of 2020, followed by France and Germany, more or less at the same size, about half the size of the UK. And then by the other countries in various orders, Spain, Italy, I think that's Denmark, or the Netherlands, and Norway and Sweden, etc. So Europe is an active market. The UK is leading, has always been leading, and continues to be very active market for technology transactions, creating some fantastic companies. But obviously, the European landscape is also sizable and quite fragmented. We cover, in fact, we've been doing deals across Europe, and last year we completed a deal with a Spanish client, with a French client, Italian client, etc. So it's a very active market, and we're proud to serve it. So thank you very much. I will hand over now to Tim for his presentation.
Thanks a lot, Pietro, and some really interesting slides there. So very grateful for those. Delighted to be with you this morning. So to represent Field Fisher's corporate M&A and fundraising team, where again I think some of the deals that we've been working on show a similarity with some of the data that you've been sharing with us, Pietro, that Q2 things sort of fell off a cliff, and we spent a lot of the year catching up since then. I think Q2, Q3 was largely about firefighting, and we spent much more time on the fundraising and fundraising for existing client companies that had already done some series rounds before, with M&A coming back much more into the mix in Q3 and Q4. We'll skip the slide of my personal introduction, but you can look at that later. What I wanted to talk to you about today was just a selection of 4 issues across the M&A and fundraising landscape, which we have spent more time arguing about probably than anything else. I've got one issue that I want to talk about on the equity fundraising side, which is vesting and reverse vesting of founders' shares, because that is probably one of the more contentious areas within fundraising, particularly with VCs. And then the other areas are just a selection of things that I find myself arguing about more often than not. In M&A, more frequently than ever, we're seeing warranty and indemnity insurance providing a solution. And I'd probably say that we end up using warranty and indemnity insurance providers in at least 50% of transactions now. In the US, my understanding is that that can be as high as 70%, particularly in private equity-backed deals. And even where we don't use it, it's quite often something that we'll want to look at with a client before discarding it as being something that actually is just going to add friction and time to the timetable. And then moving on, I've chosen 2 final areas which are not particularly M&A related, or on the corporate side at least, but are things that we argue about quite a lot. IR35, I kind of lump into this area tax generally, but within a subset of tax, IR35 probably gets more airtime than any other areas, and this is where contractors used by tech companies should rightfully be seen as employees rather than contractors, and that can lead to deal blockages. And then finally, in the tech space at least, no talk would be concluded without a brief word on data privacy, so I'll include a little section on that. So in equity fundraising, vesting and reverse vesting seen quite often as a technical area, but it's relatively simple to explain. Investors are always looking at a new investment for 2 purposes. One, they obviously like the technology, that goes without saying. But the thing that really sets aside the company they want to invest in is not just the technology, it's going to be the management team. And they want to make sure that the founders are going to stay for the journey and not leave when things start to get really tough. And that's particularly during later rounds, as we often see Series B, C, and beyond. For a lot of the tech companies we work with, you can see the founders starting to get fatigued as they get towards the point where they're contemplating an exit or an IPO. Things get progressively harder, and they want to make sure that the investors are going to stay that course. In the unlikely event that a founder does leave during the vesting period, this is a period where the founder's shares will likely be at risk. The vesting mechanism enables the company to incentivize new management and hire new management, if necessary, without heavily diluting the other investors. I've never actually personally seen a founder leaving during the vesting period. I think it is quite unusual, but it does happen periodically, and it always leaves the investors with quite a stressful time trying to find the right person to fill that gap. And being able to take the management's shares either through good or bad lever and to reallocate them is a very useful tool. The key is to strike a balance between the founders vesting of their shares in a series round and the needs of, or the concerns of the incoming investor. But it's not like having an option scheme. You're not going to have more than just the basic trigger events. You're not going to have to add to that benchmarking or KPIs or anything else. It's a relatively simple tool. And also generally the later the series round, so once we get beyond B and C, as you start to approach a timing in the life cycle of a tech company where an exit might be a possibility, or if not an IPO, then the portion of shares the founder will have to treat as as already be able to treat as already vested will grow. So I just thought I'd share this slide to show what we see most commonly as the market standard period for vesting periods. Usually we see somewhere between 36 and 48 months post the date of the investment as being the timescale over which management's shares will become fully vested, and that is they'll no longer be at risk if they were to leave. Commonly we'll see what we call a cliff period. If the management leave during the first 12 months post investment, they're at risk of 100% of their shares, and thereafter there's normally a sliding scale of between 12 and 48 months, and those shares will vest most commonly on a monthly basis rather than a quarterly basis. And then the bit that I really wanted to talk about, and this is a little bit technical, but it should be relatively simple to explain. As we go through the rounds and approach that exit point that I was talking about earlier, we see the vesting triggers shift from a single trigger, i.e. the point at which the management's unvested shares will accelerate is being triggered by the sale of the company. If the company sells, put simply, the founders' shares will no longer be at risk, and they'll be able to transfer all of their shares as part of that transaction. But commonly now, as we approach that exit point, if you're in what might be the penultimate or the ultimate investment round before an exit or an IPO, we are more commonly than not seeing investors wanting a double trigger. And the reason for that is you don't want management to leave at the point of exit. You want them to be incentivized to stay beyond that period. And any acquirer or investor during an IPO is going to want the management to stay for at least a 2-year period post that exit or IPO date. And so the double trigger means that not only would there have to be the sale or IPO, there would also have to be that period during which management stay. After that, their shares will be fully vested. So you'll see this life cycle as you go through the rounds. The founders think they're safe and have got their shares back fully vested, but then they'll be required to reverse vest some of their shares periodically. One thing that we have increasingly been able to successfully argue on behalf of management is, well, okay, we'll accept that our shares are going to be on risk for a 9 to 18 month period post exit, but we want a reciprocal protection during the run up to the exit. So quite often there'll be a 3-month pre-closing window, and it happens very infrequently, but we do see if an exit has been brought about through stress in the company, and particularly because the investors are dissatisfied with the performance of management, you do occasionally see particularly CEOs being replaced in that run up to an exit. So this is a mechanism that we would put in place to try and protect founders during that stressful period pre-exit. So the next thing I wanted to talk about was the use of W&I insurance. And as I said, probably almost all of the deals I've done in the last 12 months, we've ended up talking about W&I, and I've used it in 3 or 4 transactions in the last 12 months. Commonly on a standard exit, we end up trying to balance the needs of the sellers in having a clean exit, and the sellers will always want to get away with an exit and take their cash as cleanly as possible and be on risk in terms of warranties and indemnities that they have to stand by for as short a period of time as possible. And particularly in private equity backed transactions where there's a secondary, the management team will be expected to give the meat of the warranties and stand behind all the operative warranties, stating that the assets and liabilities of the company on behalf of the private equity fund that will basically just give title only warranties, and that's a hardship for the management because they're not taking the lion's share of the cash at that point. So this is where most commonly a W&I policy can bridge that gap so that the buyer is comfortable that in the unlikely event they have to bring a warranty claim, they're going to be able to go after a policy firstly, and you'll see in this purple block in the middle, that's sort of the proportion of the consideration that is likely to be covered by a warranty indemnity policy. They are expensive. It costs about 1% of the deal value to underwrite the policy. So it's rare to cover 100% of the consideration value. But what we normally do now is we would structure it so that the sellers are on risk. They have a personal liability for the excess under the policy, which again is about 1% normally of the sum underwritten. So there is some skin in the game, and this incentivizes the management team that's standing behind the warranties to undertake a thorough due diligence exercise and be honest in their approach to warranties and indemnities. But thereafter, we would go after the policy, and we would normally structure it so that there's an obligation upon the buyer to claim under the insurance policy first, and only in the event that you're unsuccessful in that claim because the breach that has caused the loss is excluded from the policy. Only at that point would you go after the sellers themselves. So as I said, we're increasingly using these policies to bridge the gap between buyers and sellers to enable a cleaner exit whilst providing necessary protection for buyers under the sale and purchase agreement. The W&I policy is almost always, probably 98% of times, the W&I policy will be a buy-side policy. But increasingly, when we're acting with sellers to package the company and get it ready for exit, we have found that by putting what we call a stapled sell-side policy in the data room as part of the process, it gets buyers, it sort of manages their expectation and gets them ready to expect that they're not going to be covered for 100% of the consideration. In fact, quite a bit less than that. And it starts by starting that negotiation at the very beginning about the quantum of liability or the limits on liability for buyers. I think it gets sellers to a much better position. But even though you've structured it as best you can to start with, the policy will flip over to being a buy-side policy, and we do occasionally see buyers saying that's fine, we accept the idea of W&I cover, but we would like to be the people that choose the broker. So you occasionally see a broker switch. Most brokers will end up acting for the buyer. So if you choose the right one to start with, that is known in the market for being straight in getting the right deal, they should be a broker that most buyers will be comfortable with, and that's the way we tend to prefer it. All underwriters will expect a thorough due diligence exercise to be gone through by the buy side, and we often see sellers saying, well, look, we're dealing with the expense of a W&I policy. What's the point in having to go through a detailed DD exercise? Well, there needs to be a thorough report provided by the buyer. The buyer will have to supply copies of all of their due diligence reports to the underwriter for the underwriter to go through those with their advisory team and to be comfortable that a proper thorough exercise has gone through before they will write the policy. And if you try and cut corners by leaving out some of the overseas jurisdictions or only covering the most material entities within the target group, you will find that the areas that haven't been diligenced will be excluded from the policy. The other thing to bear in mind is, and this can often be quite frustrating, having got used to the concept of a policy, unfortunately, when problems are unearthed during the due diligence exercise, and these lead to a discussion about indemnifying the buyer for these specific risks, those indemnities will not be covered by the policy. And as a result of that, just recently we found we ended up with two policies. One general policy covering unknown risks, and as I come on to in a minute, because of IR35, we had a tax issue where we suddenly discovered, or the buyer discovered, that there were a number of contractors that should really have been treated as employees, and therefore there was a tax exposure. We were able to get an additional underwriter comfortable that it wasn't as bad as may initially have been found, and because they were a tax specialist, we had a separate policy just to cover that tax risk. So I'll segue onto IR35, and this is when contractors should rightfully be seen as employees. And I'll just start with this slide, which is it's an old case, but it explains that the aim of both tax and national insurance provisions is to ensure that individuals who ought rightfully to pay tax and NICs as employees can't, by the assumption of a corporate structure, reduce that liability. So a lot of tech companies outsource dev work to teams, often through a corporate structure, rather than hiring them as individuals. But as of April next year, it's been postponed because of COVID, but the starting point of IR35 in April means that very often corporates will be seen as should be seen as employees rather than being allowed to be corporates. If you could just go to the next slide, please. There is a small company exemption. So for companies with less than 50 employees, or balance sheet less than 5.1 million, or turnover less than 10.2, and the criteria is to have two of those three to fall within the exemption, then IR35 won't be applicable. However, and this is where some companies become unstuck as they're heading into an exit, the size of the group's parent will determine whether the acquired company qualifies for the purposes of this small company exemption. The main point to make here is that when we're acting for sort of tier one tech providers, and we act for a number who will do sort of 5 to 10 acquisitions a year, they take a very conservative view of IR35, and when there are contractors in the structure, they will always insist that those contractors enter into a service contract or employment contract as part of the closing process. And they will also take the view that if they have been providing 100% of their time to the target during the run-up, it's likely that they will be seen as an employee. So that's something to see in advance of the exit and start sorting that out. And final area I wanted to cover, my data privacy team is always one of the busiest teams in the firm, and they are active in due diligence for most of the exits that we work on in the tech space. I think when the GDPR first came into force in 2018, there was a little bit of excitement and panic as people started to get their ducks in a row. That has sort of subsided now to an extent, other than in areas where there is a huge degree of personal data, and that tends to be in digital health and those sort of areas where there's a lot of personal information involved. But the fine that really got people to think was when Marriott Hotels acquired Starwoods. Unfortunately, they didn't carry out a thorough enough exercise of due diligence on the data privacy side. And as a result of that, the ICO fined Marriott Hotels 18.4 million for failing to keep customers' personal data secure. So the one area where things are really risky, that's on data privacy, that's on cybersecurity, and making sure that customers' personal data remains secure and is safe from hacking. So what I would say here is you as an acquirer will be responsible for your service providers. Make sure that you've got strong contracts in place with them and security and decent GDPR terms put in place. So acquirers will now carry out a fairly thorough privacy review. Quite often, if there's only employee information that's really data that is flowing, it should be possible to resolve some weakness in policies and procedures post-completion. But I would really encourage tech companies that do shift a lot of data, particularly across border, and particularly as we approach Brexit, to start looking again at whether you need to put in place what we call standard contractual clauses. And I mentioned on the right-hand side Schrems 2. Schrems was the case in Austria involving Facebook, and that's moved to a second stage now. As we look towards Brexit and contemplate data flows and whether privacy laws will change eventually in the UK, at least initially we don't think they will, but we're just starting to look at whether separate standard contractual clauses are needed in the UK. So that's all I wanted to say there. Thank you very much for listening to me today, and I'll hand over now to Matthew.
Well, good morning, everybody. Thank you very much, Tim. Yes, so what is it like being the CEO, the recipient of all this fantastic advice, and honestly, the person who at the end of the day actually needs to persuade investors that you're going to make them lots of money? So let's just go back to 2010 when I founded a company called GigaClear. It had a very, very simple proposition, which was to build new full fiber networks in rural areas where people had absolutely appalling rubbish broadband. The idea being that if you've got rubbish broadband, then someone who comes along and gives you fantastic broadband is likely to be somebody who you're going to buy services from. It was a real, I don't know, sort of grassroots type of business. Literally, you can see down at the bottom right there, we had a village hall meeting where we got to the end of the presentation and we said, please put your hands up if you're going to order the service and support us if we come to your village. And as you can see, lots of people put their hands up, and actually they did order the service, and we, as you can see in the little picture above, placing their orders literally there and then on the table. So really back to sort of hardcore, persuading people to part with their cash. This business is very capital intensive. So it requires you to actually dig up huge amounts of the countryside, putting in new fiber in order to connect these people to fabulous broadband. Started that business in 2010. Essentially went through a whole series of rounds of private investors, very much supported for the first, I think 12 million or 14 million through EIS, which was, incredibly useful, because essentially we were an unknown company doing something that nobody believed would be successful, certainly in the telecoms industry at the time, because why on earth would you need fiber when BT Openreach was going to solve everyone's problems as long as you waited long enough? Anyway, the business actually ended up being incredibly successful because essentially we had a real customer problem that we were solving. I mean, once you moved onto a fiber network, the chance of you ever moving back onto a copper network again is pretty much zero. So I'm going to come back to some of the financing challenges in a minute. No, that's perfect. But one of the outcomes is that is an exit that I hadn't expected. We actually got taken over. One of the bits of fundraising I did was in 2014. We actually tried to list the business on AIM. The net result of that is, and I didn't really understand at the time, is that once you've actually gone through that process of putting your company forward to raise capital on a public market, even if you don't raise the capital there, which we chose not to because the terms offered weren't good enough, you're then still subject to all of the takeover panel rules, and we ended up being taken over by our largest shareholder, Infra Capital, who basically now own about sort of 90% of the company. and are continuing to invest and grow that business very successfully. I went on after Zoom in the end of 2019 to start a business called Zoom after GigaClear. This looks at a slightly different proposition. So this is looking at how do you solve the problem of fabulous broadband in market towns. So this is not a rural play again. I mean, GigaClear and others are now doing a great job in rural. This is looking at market towns where people essentially have pretty good broadband. I mean, before we arrived in, this is Henley-on-Thames, before we arrived there in 2019, they basically had roughly a 50 meg service. Most people had a 50 meg broadband service. So that was okay. I'm delighted to say that huge numbers are now on our fiber network, which offers up to 2,000 megabits per second into your home today. So a little bit faster, and also you don't have the problem with when it rains, the service gets worse and worse because you get water into the copper cables. So one of the things we did differently here is really push the branding. Again, this is about how do you persuade people to change? How do you persuade people that what you're doing is something that's important to them? Because honestly, most people are actually completely indifferent to what their broadband is as long as it's working okay. So the challenge is, how do you get people to go, well, actually, it is worth me spending an hour thinking about, should I change my broadband, looking at what the options are and deciding that, yes, I'm going to move and a full fiber option is going to be what I want. So it's really a very straightforward business proposition, but pushing the brand is all about making sure that, you know, the pink barriers, they are quite standout. And they were all around Henley, which actually is now finished, and it did really help us raise awareness of the fact that there was something different going on, and what the proposition that we were offering wasn't just the same old another person selling the existing BT Openreach network with a different brand on the front. So that's really I think the business that we're in. So in both of these businesses, so over the last just over a decade now, 12 years, it's been really important for me to attract private investors. When you're starting businesses, a private investor can invest behind the idea much easier than a corporate can. So whatever type of investor you're talking to, the idea investment for an individual can be much easier. Now, clearly, what they're looking for, they're obviously looking to get a return on their capital. You know, so you need to be talking to people who understand that their capital's at risk. And honestly, you know, in my experience, keeping things as simple as you can from their point of view. Putting them into the same share class as you have yourself as the person who's founded the business, to me, you know, makes it more transparent and makes it easier for them to go, yes, I'll put some capital at risk. Many of the private investors you'll end up talking to actually have advisors themselves. You know, they will quite often have their capital in an investment vehicle. And you'll also find, in my experience, many of them are in the financial industry as well. So you get people who understand transactions, understand investment, and understand a sort of portfolio approach in their personal investment strategy. EIS, I've got to tell you, makes things 100 times easier. So at GigaClear, we had EIS. At Zoom, we didn't. It makes it much more difficult. Now, I'm delighted to say that because, you know, I was in a better position myself, I could put more capital up alongside the initial private investors I took on board. So, you know, their downside risk was reduced because, you know, I'd already put a significant amount of capital into the business. However, private investors, you know, they are looking for a return. And one thing I would recommend if you want private investors is to put in place a every 3 or 4 months, put in place a meeting with your investors, obviously virtually these days, and talk to them about how you're getting on with the business. Because the more communication you do with them while things are going well and while you're overcoming issues, is the easier it is next time you're asking them for more capital. And if you're growing a business, inevitably you're not going to get all the capital you want in a single round. So you're going to go back to your investors more than once. The more you communicate with them, even though they're individual investors and they might have only put £50,000 or £20,000 into your business, those are the people you need to keep talking to, because they'll do the same again next time. Okay, and then you need to attract institutional investors. So you get to a scale where your business just requires the depth of investment, and you need to be able to space out your transactions. So you can't be going back and trying to raise money every 3 months or 4 months or 5 months. You've got to actually give yourself a bit more leeway to actually build the business and deliver what you're taking the capital for. And that means you need to go to people with much deeper pockets. Now, the whole transaction, and obviously we've heard lots of good advice and information about transactions so far today, but the transaction is very much about risk mitigation for the investor. The investor looks at the opportunity and they go, hey, the opportunity looks great, it's fantastic, right, how do we make sure we don't fail? It's about thinking about how do you present what you're doing to the investor so they can go, yes, the chance of this investment actually not failing is good. So it's got a good management team, it's got a clear market proposition, it's got customers, it's got actually a product that they're already delivering. Those are things that the investors really want to see. Institutional investors want to see. Now, it doesn't matter whether, in my experience, whether you're going for private equity, whether you're going for infrastructure investors, although most people, I guess, listening to this probably don't talk to infrastructure investors, a sort of special category, or even when we went to AIM, when we went on our AIM roadshow, they were asking the same questions. How do we make sure that the big issues don't actually crush the business before we get a chance for it to create value? So in my experience, they are you need to really prep up for the DD, as you've been hearing earlier on, getting ahead of the curve, really thinking through what is it that these guys are going to be looking at, what are they going to ask for, and then prepping up all your information so it's really readily to hand. And then the type of advisors you take on is important. So, really think about what's the investor you want to attract. What is that? And then you need to find advisors who have good access to that type of investor. And again, try not to do it generically. So if you're in a biotech business, don't try, who's all the, I could go to every type of biotech investor. No, think of what's your best investor? Who would be the person you really, really want to have? And then get your advisors as if that's the one you're going to get. Almost certainly you won't get that one. You'll get someone completely different. But if you put your investors together, so your advisors, your legals, your finance, if you put them together to get your key, the absolutely perfect investor, they'll then have the network, they'll have the contacts, they'll actually have the understanding of what prep you need to have done to be successful with that investor. Having good advisors is really important because it is a huge amount of work to close a big deal. Do not misunderstand. I mean, I've just with Oaktree, we've just spent, crikey, 9 months almost to close that deal. Now I realized COVID was in the middle of it. We closed final at the end of September, but it is both a marathon and a most enormous amount of work. And they have very, very smart people who do a huge amount of work their side, and they ask you very, very many questions that you need to answer. And then, of course, they also then employ advisors who then ask, a gazillion more questions, which may or may not end up ever being useful, but they do ask the questions. So, well, have fun if you're out raising money. Good luck. There's definitely plenty of capital out there to be got, but don't just kiss the first frog that you get. Do think that this is someone who I'm going to be working with for years. Are you actually going to enjoy working with them when stuff's going wrong? are you going to enjoy working with them when you've got to tell them that your number 2 person in your management team has just quit? You know, these are the things you need to think about, because actually you're going to be working with this investor for years. It is not about the deal, it's about what happens after the deal for you as the chief executive. So just think about, how is it going to be when I have to call at 7 o'clock on a Friday night to tell them some bad news? I mean, hopefully, you know, that won't happen. But as many of us who run businesses know, there's always some bad news on a Friday evening. So best of luck, everybody. Delighted to answer questions later on. Thank you very much. And over to you, Paddy.
Thank you, Matthew. I'm Paddy Maguire, Pietro's partner, Silver Peak. I'm going to be chairing the Q&A session later, and I'm just looking at the number of questions we've got. So I think if any of you have questions on your mind, by all means, get typing and put them in there, and we'll address them during the Q&A session later. I'm going to just raise some practical points for an optimal transaction. This is related to both M&A and fundraising. Not all of them are both. But let's start off with the getting clear objectives, which is what we refer to as the 3 hats. Most people think they have an objective, but actually when you're an entrepreneur like Matthew, you wear 3 hats at least, and those being the company hat when you think of your objective, the shareholder hat, and the management hat. So it's important for you to identify these separately, but also for everyone around the table to identify them. And in doing that, what you find out is whether there's alignment or conflict. Now, you may find there's conflict maybe between shareholders, but what you may find actually is everyone's aligned, but there's conflict between what you want to do as shareholders, who you may be very conservative or tired, and what the opportunity available for the company is. And so trying to understand that allows you to get some clarity on what to do next. So how do we so here we say how to start to think about exit. I guess the question is, why should you start to think about an exit if you've not yet? One reason is to provide whether you want to realize your shareholding in 15 months or 15 years. It's important to have a framework of some kind to map your path down there. And you know, for a healthy business, if you're trying to work that out, one good thing is to set some financial objectives. And one important thing about your financial objectives that will influence that, for instance, is whether if you've had £350,000 invested and your revenues are sort of growing at 100% and you're already at 10 million recurring revenue, or whether you've had 65 million invested and your revenues are still 2 because you're about to break into the market, what you need to do is very different. You need to be aware of that and also influenced by the market opportunity. And then, you know, and so that influences timing. And timing is an internal thing. You know, how we've got this objective of reaching an exit of X million pounds or X $million. How do we get there? But what also needs to influence your view is actually what's happening in your competitor landscape, and is that changing? Is your 3-year plan actually going to be there when you get to the other end? And what's happening with your acquirers? Important question: how many competitors have you got, and how many acquirers are there? If the acquirers are buying, you may not have an acquirer when it's time to sell. Which brings us on to identifying the buyers. So when we'll come on to how you do this just in a moment, but you know, an important question to ask is, what are they buying? And it's important to get to know them. Now you can get to know them in 2 ways. One way is you literally get to know them, you get trade shows and things like that. Another way that I know a very successful CEO does is he gets to know them by beating them at trophy marquee pitches, customers, and that gets them noticed, and therefore your problem that needs to be taken out. And lastly, speak to other CEOs. I'm always surprised, A, people who don't speak to their competitors, B, don't speak to their buyers, but also just don't speak to other people who've gone through the experience of what they're going to be doing. Because there's a huge spectrum of normal, and if you only speak to one person, that's your data point, and what you want to do is get a range of data points. So in that journey, in that journey of looking at an exit, I guess one question you're going to be asking yourself is, can you get there on your own, or can you get there with what you've got, both management and money, or do you need further funding? Many VC-backed companies find themselves at a fork in the road, which is, do we raise another large round, dilute a bit and grow to create a bigger pie? Ultimately, it should be value enhancing for everyone, otherwise why would you do it? Or do you sell? Or do you do something in between? And the answer to the questions on the screen here will also help you determine the strategy. And that helps inform what options are available to you and whether you're in a strong position or not. As an example, there's a company that is currently has ARR revenue of 15 to 20 million. It's been flat for about 2 or 3 years, but recently they brought in a new management, new CEOs, brought in a new team. And the existing investors, a condition of the CEO coming in was, I need enough money to get us through. So they've provided money. It provides a nice return, interesting business. Everyone comes out happy. However, the CEO is saying, look, the market's growing hugely now. We've repositioned ourselves. And if we raise another 15 million, we can turn this into a 100 million ARR business in 4 years' time, 5x growth, for which we need 15 million. And the existing shareholders are sort of tired and spent, so we need a new kind of investor. And so they're looking at getting a growth investor. The growth investor, because the valuation, would like to have a bigger equity stake. So therefore, they're looking to sell some shares in the secondary placing as well, in order to attract the right kind of shareholder. But by answering the questions here, that helps you sort of frame how you're going to be able to go forward. And the last point here, number 8, the dual track. For those that don't know, dual track is when you're looking typically at a funding exercise or a sale exercise. The sale may be not a complete sale. It may be just a big slug of liquidity and maybe some growth capital alongside it. But increasingly, we find when we're doing fundraisings, some of them turn into a twin track often because of strategic inbound interest. Okay. So before you sort of get on with any of these, what we recommend is getting your house in order. And this sounds very trivial, and most people sort of say, yeah, we'll give this to person, safe pair of hands, get on with it. But let's not underestimate this. This is so important, because if you don't do this, things don't happen. We've recently seen a company that is almost $10 million EBITDA, growing at 100% per annum, has never produced a set of management accounts in its life. And in order to do anything in terms of raise money, this is a funding and secondary potential transaction. We've had to make them go backwards and set up and create a load of management accounts, so you've actually got something to compare with, and also show you run your business well, let alone doing the forecasts. And we had another company that recently they had 10 acquisitions. They amalgamated them onto a new account system over 12 months. But what that meant was there's nothing comparable, and so they need to wait 12 months before they can do anything. But accounting sounds very boring, but that's important. On the right hand side, customer contracts, clean IP, fundamental. Customer contracts, reviewing those to make sure you actually have customer contracts that have been signed. Again, we had a client that had a 20% revenue customer that had not renewed for 5 years. Doesn't matter while you're trading, but when you're selling or doing a fundraising, it does. And then corporate documents, repository, company filings. This is the most boring of this sort of keep your house in order, but so important. We had a transaction, actually Tim and I were working on it, and a few years ago, where because a share buyback had been done incorrectly compared to the Articles of Association, it was deemed to be invalid. Now, did that matter? Well, it was 5% of the equity, which was supposed to be bought back for £10. And if it was not sorted out correctly, that was £5 million going to an underperforming ex-employee from 5 years ago. So getting these things right is really important. Now, how you identify potential buyers? Here's just some quick tools you can have. You look at product and technology maps in your ecosystem, so to work out where everyone relates to each other. You then look at different people who would have different reasons to buy you, and so put them into buyer buckets, as we call it. And then on the left-hand side bottom, you prioritize them. And when you're prioritizing them, you're looking at the strategic fit, the firepower, have they got the money to pay, and the M&A propensity. You never want to be the first overseas acquisition for a big US domestic player, unless you are their pre-IPO acquisition to demonstrate how international they are, in which case that will certainly happen. And when you're sort of trying to work out, what value you might be to different people in that in the matrix, this commercial synergy matrix helps you work that out, and it gives you some tangible value, and whether that's a lot or not. And if it's not, that's as important to know as if it is. So we've sort of been talking about corporate buyers, but we almost always will go out to strategic and financial private equity buyers at the same time. And they're very different animals. It's really important to understand their different animals. So strategic guys, they focus on strategic fit. That's fundamental. Are you filling something that they've not got? Bear in mind, most of them have a buy or build situation. They take longer typically to come up to speed. They're more flexible in their structure, but if they want to integrate you, they'll be paying cash on the nail, and typically would demand exclusivity after they get to heads of terms. Financial investors are very different. They're focused on the KPIs. Typically on our first call with them, we'll be discussing KPIs because they'll be asking about them. But they're transaction machines. They get up to speed very quickly, but they do intensive deep due diligence, as Matthew found just on Zoom. But they'll be doing financial, legal, commercial, and technical due diligence if appropriate. And because there's such a wall of money out there for these assets, they're very competitive, but also often you'll be able to have them running in competition after heads of terms to get to the end. So what you won't be getting from the financials is strategic value. Even though for many mature businesses, private equity outbids corporates easily, but that's because of the leverage they can bring into the companies. But for for companies with inherent strategic value, what you really want to be doing is focusing on what is the value to the buyer and how do you articulate that. There are different situations require different kinds of process. There's not one M&A process, and here we've just highlighted 4, which we'll illustrate with clients we've sold. So something like Magic Pony, which was bought by Twitter. This was a under 2-year company, no revenue, fantastic patented IP. We wouldn't be able to sell that unless someone wanted to buy it. So this was Twitter coming in to approach, where we ran a process, and after 2 or 3 rebuffs, that got sold for reportedly $150 million. Facebook bought PlayGiga, a Spanish game streaming platform, which we sold this time last year, which is very much a soft process. There we're talking to quite a number of the FANGs, we're talking to quite a number of telcos, and there was a lot happening in the marketplace, but we had to, because it was, again, a young company with little revenue, I mean, it had revenue, it had customers, but we had to run and get everyone sort of bought into that far slower. Structured auction down with Virtual Clarity. This was a consulting business, very sort of high levels for digital transformation of big companies. We ran a structured auction there, managed to sell it for 3 times revenue, and there you had DXC who bought it, but competing with strategic consultants like McKinsey and then their competitors like Cognizant, Accenture, and those guys. But that was a bam, 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 high pressure. And I think we closed that actually in something like 19 business days after heads of terms. And then dual track for autonomy sale to Blue Prism, that started off as a cash in, cash out deal, I call it, which is private equity putting money in to continue the growth, fuel more growth, and getting some cash out for the shareholders. That morphed into a dual track because strategics started to approach inbound, and ultimately we sold that to Blue Prism. So when you are thinking of buyers, most people, or even investors, you think of them as funds, names. What you got to think of them as people, because that's what they are. So, and in that, you've got to identify the key buyers, and typically these are the 3 groups. You've got an M&A team who will execute on behalf of the champion. The champion's the guy who wants to buy it and will have P&L responsibility afterwards. But ultimately, you need to identify the decision maker, because you don't want to be negotiating twice, and you want to make sure that they're satisfied. And now we just come into the last 2. So when you're engaged in the marketing phase, so you're interacting with the buyers, you've done all the preparation work so that you can respond quickly. Remember, you're selling. That's really important. Some people sort of seem to forget that. So articulating things very clearly. Perception of value is created by every piece of information you give and every interaction. Communicate good news throughout the process, and don't ask for a term sheet or LOI prematurely. Make sure they've got all the information they need, so that when you get that, that is the deal you expect to close. And lastly, some nuggets of wisdom for negotiation. Negotiation starts at first contact. If you get an inbound call, don't jump on an aeroplane the next day and go and see them. That suggests you're too keen. They're signaling in everything you do. Competitive tension is important, real or perceived. We once negotiated the sole buyer up by 40% because their fear that they were competing with the nemesis competitor of theirs. Greed and fear drive deals. Understand who the decision maker is. You don't want to be negotiating twice. Understand what's really driving the deal. Facebook were in such a rush to be able to launch their game streaming business. Unfortunately, it was held up by the issues in the Apple Store. And be clear who plays which roles on our team. And that's not just good cop, bad cop, but it's the whole process. It's a team game. And lastly, it's not done until it's done. We once lost a deal 3 days before completion because of the falling share price of the buyer. We closed it 6 months later, so there's a happy ending. But it's never done until it's done. So that's all from this section. Now we'll gather for the Q&A. And if you wish to submit any more questions, please do. I'm looking over here because that's my question screen. So while these are coming in, I'm going to just ask a question of you, Pietro, which is, I briefly mentioned, refer to growth and venture investors, and at different stages, different kinds of investors, different sort of investor groups come in. So what distinguishes in your mind when a venture investor is in and when that might morph into a growth investor?
I guess the easy answer is the type of company they invest in and the size of deal. Typically, with A round or seed round investors, the companies may have either no product at all, no revenues, no clients, typically organizational size, say 10 to maybe 40, 50 employees. And the rounds there are, in the seed round, they're growing in size, but say from 1 million to 5, maximum 10 million. While growth investors really are looking for companies that have already a product market fit, their capital is used to accelerate, not really to, if you want, test the idea. So at that point, management is in place largely, maybe not complete management team, but they are backing a team that has demonstrated capabilities to deliver, and they're looking for data. They're looking, as Matthew said, they're looking for ways to de-risk their investments. That's what growth and late-stage investors are trying to do. Obviously, the opportunity is ultimately the attraction, but the risk-return profile has to be mitigated in some ways, and that's where you start to actually look for KPIs and data that supports statements. If you say that you're going to grow your business at 50 to 100% per annum on a business plan, people may or may not believe you. If you demonstrate that you have been able to do it for the last couple of years, all of a sudden your statement acquires a different flavor. And that's what Matthew was talking about in terms of preparing and making sure that you have the documents and the underlying analysis to demonstrate your statements so that you take away risks effectively.
Thank you. Tim, some questions on W9 insurance. So I guess a blunt question is W9 insurance hollow? And as in, does it pay out or not?
Does it pay?
Does it pay? And I guess linked to that is there's a sort of holdback, which is the equivalent of the excess. And do you see that the excess actually makes any difference to the premium, or is that really just trying to wipe off the expected risk?
So answer to the first question, put simply, is yes, they do pay out. I think the market has matured substantially in the last 5 years. And when we first started looking at policies 5 to 10 years ago, there was some nervousness about this point that they wouldn't pay out. There's now quite a depth of underwriting in this space, and most of the brokers that we work with will go through the underwriters, and they'll categorize them obviously by cost, but more importantly than cost, given that they mostly come out in about the same space of around 1% of the sum underwritten, they will order them by the expense, the claims history, and we have found that to test this, particularly with Japanese acquirers that are historically quite averse to litigating and much prefer to resolve their disputes behind closed doors. If you give them an insurance policy, they love an insurance policy to claim on, and we have seen and anecdotally through the brokers that we work with have heard of quite a series of claims by Japanese companies that have all been paid out. So yes, they do pay out. It's not hollow. Your second question about the excess, look, I think you can structure it a number of ways, and it'll come down to cost, and there obviously is an upfront cost in taking out the policy, but I see it these days as a kind of cost of making a problem go away. 1% tends to be the excess of the policy, and it tends to be where sellers
premium,
like.
So the 1% you mean is the premium rather than the excess?
Sorry, correct. Yeah. We tend to structure it about the same amount. It's sort of 1%, and that tends to be the element of skin in the game that we want to see. Historically, you would see much larger sums put into escrow and tie that up for a period of time to provide some surety in the event that there is a claim. I think these days sellers are much more averse to the idea of escrows. Escrows are much more expensive and annoying to set up than they used to be, and you have to go through AML every time to open the account. And I think we're just increasingly seeing warranty and indemnity as a cleaner way of bridging that gap between buyers and sellers.
Thank you. Matthew, you've now had two sort of groups of institutional shareholders. I know it's only early days with Oaktree, but how would you contrast the sort of the culture? Just bear in mind they're both infrastructure. You had two infrastructure type transactions, so it'd be interesting to know how the animals might be different in the same market.
Well, they aren't quite the same type of investor. I mean, we had, in fact, we had three institutions in GigaClear, big institutions in GigaClear. One was a pension fund, one was essentially it was one of Woodford's vehicles, and the third one was Infra Capital, who was an infrastructure investor. They all actually had different approaches themselves to the business. Oaktree are definitely a much more active investor. I mean, they are, I think, more typical of a private equity investor who is looking to help the business drive growth and value creation. So then they are more active, more engaged with the business, and actually come with a better set of support services for the company. With expertise that they apply at, as part of the deal, from helping you identify and recruit new people into the business, helping you update your systems and processes as you need. And actually they have a whole bunch of analysts that we could actually buy time from if we wanted to as well. So they're much more set up to help drive the growth of the business than more traditional infrastructure investors who essentially, although they have a lot of analysis, they aren't well set up to actually actively support the company.
Thank you. Pietro, question being asked about the time it would take for a typical fundraising from sort of engagement to money in the bank.
Typical, we say 6 to 9 months is our experience, and it's an elastic though indication. That is, you can mostly plan for the preparation phase when you're actually, heads down, putting together the presentation, a financial model, the data room, valuation analysis, etc. And that's something that is more or less in your control. And you can somewhat plan, but I think this is a good question maybe for Tim, for the final phase of the process when you're drafting legals and trying to close the deal, even if there is a fair amount of variability. What is hard to plan for, unless it's a very regimented process, but not many processes in technology are, is the marketing phase, when you're actually engaging with counterparties and getting them in love with the idea. You really want to get them excited about what you're doing, about the opportunity, about the company, about the market. And that's a phase that does take some time because there are externalities. They can be busy on another deal. They can be just taking more time. It may be that you cannot get hold of the right person for a period. So there are, and it also requires some interactions, etc. So that's a phase where you need to address questions. You need to take some time. That is not always in your control. In fact, it's not in your control. Even if you can influence it, and you're going to keep as much control as you can. But that is elastic. And I guess also the last phase for closing is elastic. I don't know, Tim, if you want to comment.
Yeah, I think that, good points there, Pietro. The one thing I would always say to all clients is that the process will take way longer than you anticipate. So don't plan for a 3-month process, particularly if you're doing a fundraising and you're running out of runway before you're out of cash. Make sure that you start the process at a point in time when you've got strength on your side and you can negotiate the best deal possible. In terms of what can shorten the legal process, so from the phase at which we tend to be instructed, which it varies, but normally around the point that you start negotiating the heads of terms or the letter of intent, the best way to condense that process to, say, a 3-month window is if you've got your data room fully populated in as neat a way as you possibly can. And that is within the control of every company looking to do a fundraising. If you've got all of your employment contracts laid out nicely, you've got your claims history in terms of any litigation, any problems that you think, or skeletons in the wardrobe that you're going to need to get out there, make sure that you've got every piece of scrap of evidence that is going to be asked for, and have it ready and have your story ready as to how you're going to present it, and also to when. You don't want to put everything in the data room necessarily day one, particularly if you're negotiating with a strategic or a competitor. You may want to hold back some of your best customer contracts until late in the day. But make sure that you've got your data room set up so that you can populate in waves and do so swiftly and efficiently, because if the buyer or investor has to keep coming back and re-asking the same questions, they will get frustrated, and it comes across very badly that you're disorganized in the way that you've dealt with your contracts. And I think it's even harder now that we're working remotely. CFOs often get tasked with the unenviable task of getting the data and put together. If you're not in the office physically, it's a lot harder to gather things together. So start doing so before you need to.
If I may add just one quick word, you should have more cash in the 6 to 9 months. You should have cash for at least another 3 months. Otherwise, you're going to be with the back to the wall in the final negotiations, and investors will try to take a stab at valuation of some terms. So my recommendation is have 12 months of cash in your bank before starting a process, so that you're in the best position at the end.
And that answers the question from the CFO of a Series B business with 12 to 15 months, asking if you should accelerate your Series C. You should just start your Series C, because that puts you in a good position. There's a question from someone saying, if for software, for instance, if many buyers are in the US, does it make sense to use an advisor based in the US, or have an advisor close to the European HQ? Pietro, I'll put that to you.
It's a lob for, but it is a frequently asked question. The reality is that you want advisors that are credible in the eyes of the counterparties, whether they're based in the US or Europe, doesn't matter. We do deals with, we do not have a US presence, a full US presence. We have in fact, a representative office in San Francisco, but we don't have staff on the ground. What we have, however, is very good relationship with many of the buyers and the credibility that gets us to speak with the decision makers. At the end, they will do the deals that are interesting to them. And what you want is to have someone that is able to represent the opportunity and to get through to the right people. The location of the office is not most important. There are several banks that have multiple offices that will staff local teams on the mandate anyway.
And
Yes,
yeah, sorry, Paddy. The same goes for your lawyers. You know, we work on every US transaction with friendly firms in the US. Again, we have a rep office, but we tend to work with 4 or 5 law firms in the US that we work with quite regularly on transactions. But you'll try and structure the documentation so it's friendly to the target's territory, wherever the acquirer's from.
Yes, we've got this thing about people being spread around, and on a funding deal, we've got the funding is coming out of the Californian corporate VC. The champion is actually in Singapore, but the decision maker is European HQ. So this good thing of understanding where everything sits is quite important.
Paddy, do you mind if I pick up on a question that is relevant maybe for Matthew, and is asking how is it to do deals during the pandemic, and if you really, are there any deals happening without meeting the investors? Matthew, do you want to comment on your experience?
I've got to say that the pandemic has made it much more difficult. Not so much in my experience for the investors, although you may not be able to meet at their offices. They may have corporate rules that prevent any meetings at their offices at all. So just bear that in mind. You may have to actually have them to your office, or to meet somewhere neutral where you are allowed to. But from the advisor's point of view, we just did our whole DD process without a single face-to-face meeting with any of the DD people doing DD, which I've got to say made it unbelievably painful, because everything was, sending another 30 questions by email to then us have to answer them, and then send another 30 questions by email. So I think my experience, the advisors, I think, are quite often, so this will be people doing DD as opposed to negotiating, that they can be extremely cautious and make the whole process very document and writing intensive. From the point of view of investors, though, I think they are keen to understand the business. You will definitely have fewer meetings, in my experience, than you would have done pre-COVID. But you'll have an awful lot more virtual meetings to make up for it, and some of them at extremely short notice.
Thank you. Someone asked me, what's the appetite for non-software tech investments in Europe presently? And I'm just going to answer that saying, actually, there's a far bigger universe for software, but there's still plenty of investors for non-software tech. We were just sponsoring the Deep Tech Summit, where they will gather, another virtual summit. We've recently just closed a satellite terminals business. We're working on another space business. Pietro had a sort of standard compression business fundraising. So there's money out there, but it's a different way of working and a different audience. So and on the COVID deals, actually there was I was speaking to Axel KKR, who had completed their first completely virtual non-contact meeting with a buyout about 3 months ago. I think what people find is actually to do that, you find your due diligence and all those processes are far greater, because you don't have the ability to be a bit sloppy and say, yeah, they seem a good management team, and you don't see them in the informal settings, which is what's really important in bond a relationship.
Paddy, I would add to that. Sorry, no, carry on, and then I'll chime in afterwards.
Yeah.
I was just going to say that one thing we've seen during COVID, because of the remoteness now of doing the transactions, what we would normally see, particularly if there's a US investor or buyer, they would tend to come over to Europe for the negotiation phase and quite often stay till completion or head home just after signing. At the moment, if it's all being done by paper and over Zoom, the one thing that I have seen making quite a difference is if on the sell side, you're prepared to move towards your buyer in terms of time zone. So just recently, we've started increasingly working on US hours where there's a US buyer, because otherwise you lose that. You often lose 24 hours in the cycle of Q&A and response. And if you can end up sort of taking the time zone to them, you'll get things done in a much shorter space of time, and it's really well perceived by buyers.
Okay, and one last question. So it's coming up towards the hour. What I guess probably for you probably partly answered actually, Tim, but the question is, what lasting impact do you see COVID having on corporate buying behaviours over the next couple of years? Market consolidation or innovation?
I think we're now very well set up for working remotely and working digitally, and I think that we will definitely cut down the amount of travel time that is undertaken in future. I still think there is nothing like seeing the whites of people's eyes, and I think all buyers would still like to walk around factories for manufacturers and shake hands with management and actually see the team on the ground. But they may do so in shorter, more sharp ways. So they'll do quick visits and then get out, and then back to Zoom and paperwork.
Yeah, sure. What's your take?
If I may, just the most important and I think lasting effect is going to be the effect on the industry. In reality, during COVID, we've seen an acceleration of everything that uses technology that was unthinkable just 12 months before, from penetration of online to remote working, use of collaboration tools, applications across the border. Everything has just moved on about 5 to 10 years in a matter of 3 or 4 months. And I believe that we're going to go back to normal with vaccines coming in and hopefully resuming our normal lives. But some behaviors are going to stay. So whether or not we're going to maintain all of the changes that we have experienced during this period, I don't know. But I still believe that it's going to be a different world from what we experienced. And that's why we are lucky to be active in the technology market. It is the market that has effectively benefited from this situation that otherwise is in many respects tragic. I also believe that, guys, people, it has made the world a little bit, both more global and less global. There are reasons to say that it's less global, but there are also reasons to say that now doing a deal between, UK and Spain is like doing it between London and Bristol. And that's basically both sides. I mean, it's a world of some contradictions in some ways.
So thank you. So I'm going to bring this to a close as it's 10 o'clock. So Matthew, thank you. Pietro, Tim, thank you for everyone who's attended. For those who have asked questions that have not had a response, we'll be sending you a direct one-to-one response after this. in the next day or so. The slides will be available and we'll sort of communicate to you when they're on the website. If any of you wish to follow up on anything else you've had or thought, by all means contact us afterwards. But thank you very much for attending.
Thanks a lot. Bye now.
Bye.
Thank you. Have a good day. Bye-bye.